Hello everyone, welcome to lesson 5 of the Real Estate and Mortgage 101 series. My name is Dr. Kevin Shuford. I am a licensed real estate agent and mortgage lender in Arizona and California, but have referral partners across all 50 states and internationally as well. Today we're going to be covering one of the smartest hacks in home buying, which is asking for seller credits and concessions. And so the strategies you're going to learn here can help reduce your cash to close and can even lower your monthly mortgage payment by potentially hundreds of dollars. And so most first-time home buyers don't even know that this is possible. But let's go ahead and break it down in lesson 5. So on the title slide, I alluded to why this is important, but just as a quick preview here, when you buy a home, every dollar matters. And you probably are aware of this if you're even thinking about buying a home. How much money do I have right now? How much house can I afford? What's my monthly mortgage payment going to look like? How much money do I need to actually close? What the down payment's going to be? Are there any extra fees? All these questions are spiraling in your head. And so too many buyers oftentimes think that they have to pay every single cent out of pocket. But this actually is not true. The truth is that if you're engaging in smart negotiations, hopefully your agent is doing this for you, that can actually shift thousands of dollars from the seller side to your side. And that will then make the process much more affordable and smoother, and you'll just be happier overall. I mean, who doesn't love saving money? And so this can really be the difference between feeling stretched thin when purchasing the home and feeling comfortable finding that first home and settling into it. First up, let's go ahead and discuss seller credits. So what are seller credits? These are going to be funds that come from the seller that they agree to contribute towards your closing costs. So it's very important to note that these funds do not go directly into your pocket. Okay, you cannot keep any money left over from the seller in this instance. But they can reduce the amount that you're going to need to bring to the closing table. And so seller credits can cover things like loan origination fees, title costs, prepaid taxes, homeowners insurance, and can even be used to help lower your mortgage rate with the mortgage rate buy down. And so this is actually a really great strategy for high interest rate markets where you can get a couple extra $1,000 from the seller to bring your rate from a 6.5% down to a 6%, which could save you potentially a couple $100 right there. And so think of this as the seller is chipping in to help make the deal work for you. And so this is only really going to happen if your agent is able to negotiate for these, if they ask for them on your behalf. And so if you're purchasing a home and now you're aware that these exist and your agent has not suggested them, bring this up and say, hey, what about getting some seller credits to help with my closing costs? The other important term here is concessions. So what are seller concessions? These are going to be a broader term. And so concessions do include seller credits. So a seller credit is a type of concession, but they also can cover things like repairs after the inspection is done, covering HOA fees if you're living in a community that has an HOA fee, and they potentially can help offer price reductions instead of fixing the items that show up in the inspection report. And so essentially a concession is any way that the seller is trying to make the deal move forward or make the deal easier for the buyer. And so the flexibility here can make the home much more affordable, especially in slower markets where maybe sellers are more motivated. So if interest rates are really high, if there's a lot of inventory, then concessions are a great way to go. Getting seller credits are going to be used directly for those closing costs, but the concessions just generally as a term cover a wide range of items. So how much money are we really talking here in terms of seller credits? What is the average usual credit that buyers can receive? Typically, seller credits are going to range between 2 to 3% of the purchase price. And usually the reason for this is because your closing costs are going to be about 2 to 3% of the purchase price as well. And so essentially what is happening here is you could go into buying a home and you say on a $400,000 home, you're going to do a conventional loan, 3% down. You can get 3% from the seller in credits to help cover those closing costs. So you're coming in with just $12,000 out of pocket, and that's it. It covers all your closing costs, and then if there's any left over, it can be used to help buy down that interest rate. However, it really is going to depend on the loan type that you have, because there are certain limits on how much credit you can receive. And so, for example, this can get a little technical here. So let's start with conventional because it's the hardest one. So a conventional loan, you can get between 3 to 9% of the purchase price in seller credits. However, you can only get 3%, up to 3%, if you put less than a 10% down payment. If you put down between a 10% to a 24.99% down payment, you can get up to 6% in seller credits. And then if you are able to put down more than 25%, you can get up to 9% in seller credits. For FHA loans, you can just get up to 6% just generally in seller credits. For VA loans, it's up to 4% in seller credits. And then USDA loans, which are more for rural type housing, you can also get up to 6% in seller credits. And so typically, regardless of if you're getting between 2 to 3%, it's going to be enough to help cover most of, if not all of your closing costs, and hopefully have just a little bit left over to buy down that rate a little bit. All right, so let's take a look at an example here. So a buyer purchases a home for $450,000, and closing costs are going to be about $9,000, which is 2%. So through negotiation, if we can secure $7,500, then the buyer's only going to have to come in with an extra $1,500 at closing to cover those closing costs. And so this is really great because instead of thinking, oh, I have to have 20% down payment to purchase a home, which is $90,000, which I do not have personally, right? Instead, I can come in with a conventional loan if you have good credit and get in for 3% down, which is going to be $15,000, and then I only have to bring in an extra $1,500 for closing. So out of pocket fully, $16,500, I am in the door with my keys. This home is mine. And so on top of that, you can also, if there's any left over from those concessions, get a either temporary rate buy down or a permanent buy down to help lower your monthly payment, either temporarily or overall long term, saving about maybe $300 in that first year. And so this really is a very valuable tool that you should be pursuing. You might be wondering why a seller would agree to giving concessions or credits to the buyer. The answer really is fairly simple. If, especially in markets that are really tough with high inventory or high rates, if the house has been sitting for a long time, then offering that credit is often cheaper than dropping the home purchase price overall. And so, for example, if you were to lower the purchase price by about $10,000, that's going to barely make a dent in that buyer's monthly payment, maybe about $50 per month. But if you give the $10,000 credit instead, that can help the buyer cover closing costs, potentially partial or fully, and or reduce their monthly payment significantly. Buying down your interest rate is most of the time a better option than taking a price reduction. That's very important to keep in mind. Overall here, it is a win-win. The seller keeps their home value fairly strong, and the buyer gets real immediate relief. For buyers, this is an awesome deal because the advantage here is huge. You bring less money to the table at closing. You can use those credits to help either pay off those closing costs fully and or reduce your interest rate, which is going to make your monthly payments more affordable. And if you don't have to bring money to the closing table for closing costs, now you have extra money, hopefully, for things like furniture, repairs, building up an emergency fund. Really, this strategy is going to make homeownership more accessible and more sustainable. So instead of being what we call house poor, you become able to breathe and have more room in your budget. Let's do a quick recap of credits and concessions. So seller credits are funds that are used to reduce the amount of closing costs that you have. Concessions then are going to be a broader category that can include repairs or other financial help from the seller. Typically, you're going to get about 2 to 3% in concessions, and when you apply these to rate buy downs, it can lower your monthly payment by potentially hundreds of dollars. So it's going to help cover closing costs, so title insurance, mortgage fees, homeowners insurance, HOA fees, potentially repairs. All of these things are going to be potentially handled by the seller, so you can save more money as that buyer. And it's really important to note here too that you cannot just put those concessions or credits into your pocket after closing. The funds have to be tied to something with the transaction. And so that is oftentimes a misconception, like, oh, why can't I just, if there's leftover, why can't I just put it in my pocket? That's not really how it works. But the key here is knowing how to ask for these benefits and working with a realtor that's going to understand how to structure them. If your realtor is not asking for concessions or credits, then you really should ask them why, because it is a way potentially for you to get some extra money back into your pocket by saving you on those closing costs. Congratulations, you have completed lesson 5 on credits and concessions. And now we're going to move into lesson 6, which is going to be the final lesson in module 2. So in lesson 6, what we're going to do is we're going to go deeper into one of the most powerful ways that you can use seller credits, which is the rate buy downs, talking about what a buy down really is, how they work for either temporary or permanent buy downs, and then deciding if it is going to be the right move for you. So definitely hit that like and subscribe button, and we'll see you on the next one. Very quickly before you go, I just want to encourage you to subscribe to the full Real Estate and Mortgage 101 series, because every week I'm dropping really valuable information for you if you're considering purchasing a home. And as my gift to you, if you click on the link that's in the description box down below, you can access the full Module 2 resources for free. So you get access to this video, to the PowerPoint slides, and as a bonus, there is a full vault of extra real estate resources that I think you will really enjoy. So please go ahead and check that out. It is, once again, fully free. And so I know this process can feel overwhelming, but I am here to guide you and help you every step of the way. Thank you so much. As a final reminder, my name is Dr. Kevin Shuford. I am the property professor. I have a Ph.D. in communication and I'm a licensed real estate agent and mortgage lender in both Arizona and California, with referral partners across all 50 states and internationally. If you'd like to work with me, I would love to work with you and help you get into a home or even sell your home. And so you can go ahead and contact me at the number on the screen. Text or call is perfectly fine. Feel free to email me as well. I am here to support you, and I'm looking forward to connecting. Thank you so much. See you on the next one.